Welcome to Value Investing webinar once again. Today we are going to talk about important things to look for in an annual report. There is absolutely no dearth of information on companies. Today we have databases, information is democratized. Internet has further democratized it. Everybody has access, nobody has an advantage. Not only that, it is the law of the land enables that every information on a company, including annual report, is made available to all investors exactly in the same manner. In fact, it has to be put in the public domain through stock exchanges, information about companies, and nobody can have an advantage. In fact, if somebody has an advantage, it is unlawful. Insider trading rules gets kicked in. But the most important document released by a company or reviewed by a company or disclosed by a company is the annual report, where there are many components to it, which is basically the most authentic source stated by the company of its state of affairs financially, qualitatively, and the components of the financials, which is how is the business doing in quantitative terms, what is happening to the money which has been made, and how they have generally been with the cash flows. Were they okay? So that is the basics, plus the directors and the auditors. This year onward, auditors now reveal so much more about company, or they have been held more accountable in terms of disclosing things on companies and validating things more rigorously. Today with me is Sorbh Gupta from Quantum Asset Management. And he is going to throw light, or we will gain from his insight on how does he look at annual report, what does he look out for, and how he goes about doing it, the red flags and everything. So tell me, how do you use annual report?
So annual report.
How anxiously you wait for them?
Yeah. So annual report definitely for a investor and people like us, like value investors, it's a holy grail of understanding the company. Whenever you're looking at a new company, it becomes extremely important that you go through the annual report. Ideally, we would like to see before investing any company's last 5 years annual report, so that we look at the continuity and the consistency of the annual report as well. So basically, what do you want from an annual report is information on business, people who run the business, its sustainability, its focus on environmental and social aspects, and definitely the financials of the company. So you are trying to get hold of these 3 or 4 information just to make an investment opinion on certain things, because investment at the end of it is an act of faith, and whether you can have the faith on that company, on those set of people. Annual report
entrusting our money to that company.
So the annual report can be a starting point to your investment and research process.
So talking about annual reports, sometimes annual report could be very intimidating. They could be voluminous thing. Take a look at this. I'm told this is HDFC. Some 1300 pages. Accounts of all the companies, all the subsidiaries, all the companies promoted by HDFC, the asset management company, not HDFC Bank, it's an associate, but the life insurance company, the general insurance company, and the main HDFC, which itself is a fairly rapidly evolving business, which requires a lot of disclosure, and I'm told that L&T annual report is twice as much, or maybe 2 volumes like this. So as things get bigger, things become complex. What do you look for in an annual report? Because there are 3 parts to it. One is the written words, the management saying that how it has been and how it will be, or how it will be in their view, and then the real numbers, and then all kind of fine prints where the auditor saying this is mess, this is not acceptable, this they could not make sense of it as businesses become complex.
Yeah, so the 2 companies that you quoted are actually conglomerates, so they're bound to have voluminous annual reports, consolidated ones, because they have multiple businesses.
No, this is unconsolidated. This is unabridged. This is all the new businesses.
Yeah, so with all
consolidated.
Yeah, so
unabridged.
Unabridged. So it have a lot of balance subsidiaries. So
it's like 5-6 companies.
Yes. Similarly with L&T also. So they have to have all these. Going by each businesses, one should focus on, in case of conglomerate or any standalone operations, one should look at each business as it is in a different form, and then go through each businesses and what aspects are being discussed. So broadly, if I summarize, what do you look as a retail investor? Because institutional investors also have access to a lot of databases, they have access to managements also, but retail investors generally lack that. So it becomes all the more important for you to understand the annual report and go through few important points. So first, to start with, you should go through the 10 years numbers that they publish in first and second pages. So it gives you a sense of how the business is moving. A snapshot view of things. So that is one. Then second comes the chairman's letter, right? So that chairman's letter will tell you about how the business is placed, how they plan to do things in future. Has it been a challenging year, a great year? And one has to look that letter in context with how the environment actually has been. If the environment has been challenging and the numbers have not been good, still the chairman is speaking great things about the company, then you have to be aware what chairman talks about. So there has to be a linearity between what
any chairman is you have figured that they are lying?
Yes, not exactly lying, but we
exaggerating.
Yes, so we have seen multiple companies, especially in the construction side. One example that we saw, that the environment was tough, the balance sheet was worsening, but the chairman's letter looked as if the business is going great guns. And eventually the company continued to load on debt because the bias of the chairman that the business is great ensured that he takes more and more risk on the balance sheet, and eventually the company suffers. So these
So his optimism could be misplaced.
Exactly. So they also have their positional biases.
So you have to judge those things.
Yes.
You can't take anything at face value.
Right. And that's why reading of multiple annual reports of a company helps. So that how continuously.
And what about competition? How much leads you get from competition in terms of validating these?
Yes, so definitely even reading annual reports of competition also helps in terms of understanding the business. For example, there will always be a commentary on the business and the industry where they are operating in. So there could be some managements who are generally talk great about certain businesses, and some are conservative. So if you read historically, you will have a broad understanding of how the industry is operating, and in that context you have to look at the company. So it always helps to go through the competition and other things. Similarly, then comes the composition of the board, the independent directors, their ability to look at things, what is their credibility and integrity levels and other things, how are they on the board of other companies, and how are those companies. So things like that information you'll get in director's report and board of directors. Then some information, try to look into the committees, the subcommittees that the board has.
And you get minutes of those, or highlights of all their actions?
Not highlight exactly, but their attendance and the key people who are attending that are part of that committees. So for example, in audit committee, ideally there should be 100% independent directors.
Okay.
But sometimes companies, what they do is they have a permanent invitee, an executive director or the CEO in that committee. Okay. Just to bypass that rule that despite having a 100% independent director, they will have a CEO who is a permanent invitee to do that committee, right?
Oh.
So that essentially.
So here is a interested party who is part of audit committee.
Audit committee. That should not be.
In a stealth. So in a hidden way.
Yeah. So these few things you should read through, and you should understand what's happening in
that gets reported.
Right. That gets reported. You have to report that. So that's and then the management discussion and analysis. That's like the information of the business. Firstly, we'll discuss about the macroeconomy, then industry, then how company is operating. And it is that part of the balance sheet which talks about future, the capex plan, the growth. If you look at commodity companies, it will talk about business cycles, demand, global demand and supply. So most of the information about the business, not the numbers, is in management discussion and analysis. There will be a SWOT analysis, strength,
so to say,
strength, weakness, opportunities, threat of that business, summarizing into that management discussion and analysis. So that's a very important aspect that one should go through. And then definitely these days sustainability is becoming more and more important. So a lot of these companies are now being told to publish their sustainability reports, which should be part of the annual report, about the level of pollution that they are doing, the social matrices like sexual harassments in the company, other aspects. So that will also
reflect in the culture of the company.
Exactly. So that will tell you how the culture of the company has been or is moving towards. So that helps. And you should not look these things on an isolation basis. You should also always look these things from a peer perspective basis, because any commodity company will definitely most likely be a little more polluting than a tech company or a banking company.
Sure.
So you should be comparing within commodity cycle companies, how is that company faring, right? So this should be the broader aspect on that aspect. Definitely then comes the audit report, the statutory reports, and P&L and balance sheet and other things, and definitely footnotes to accounts. So this will give you a broad sense of the numbers.
How do you spot a what do you look for? The red flag, the company, you get a warning signal while looking at an annual report.
Yeah. So
give me an example.
Look, so I'll give you an example of a very famous technology company which went bust in 2009. All of us know the name, and it was a big technology company where the promoter came out and said that the company does not have cash.
He's messing up.
Yeah, so he's messing up.
He's stolen the money, or the money wasn't there.
Exactly. So this, we did not get this information pre-hand. I will not say that we knew that this was going to happen, but when we studied the annual report of that company, after that happened, we saw that for 3 years, companies' income from FDs had not changed, despite the FD numbers changing, right? So clearly those numbers were getting dressed upon and gold plated, and one could have checked that why is the actual amount of that interest from FDs not changing for that company. This was a very small thing that one could look at. Then again, second company which always, it's a tier 2 company, was doing very well in the previous bull cycle. Now it's really in a lot of trouble, and we looked at that company. We never invested, thankfully, because what we saw is that the company is doing a capital expenditure on laptops and computers. But if I divide that amount by the number of people per capita amount
per
that
person
I get
in the company,
it's way too high. The laptops and computers don't cost you too much, that much. It was like 10x of that number. So you know that there is a gold plating on that capital expenditure that is happening.
Oh, so they were faking the number of that capital expenditure, and they didn't have as many people.
Yes, maybe they were always in the market to raise capital. They were raising capital, gold plating the capex, and maybe the founders were trying to take away the money.
Okay.
So there's a few examples that you should look at. Then one important aspect, especially in tier 2, tier 3 companies, is the list of bankers that you get in the second page.
Okay.
If a company is always dealing with banks which traditionally are not great risk takers or risk analyzers, then you should be wary of that company.
This is quite a soft understanding. Only you will have it. But how will an investor figure out
so
that?
People will have an understanding.
There is a stupid banker.
No, but over the cycle, people who have been investing understand that there are certain banks where NPA levels are better historically, and it's a well-managed bank from a perspective. And this is a typical third-tier PSU bank who tends to be stuck up in every cycle. Yeah, or maybe the biggest banker is one of the cooperative banks, right?
Okay.
So
you figure out by way of, these are not rigorous lenders.
Right.
So that you...
Yes, so definitely that company is a high yield borrower. It's not a tight market borrower, right? So that becomes a very important test that you can check.
That also enhances the cost of their capital or sourcing.
Absolutely. Okay. And then there is a difference between the EBITDA growth of the company and operating cash flows. Whether actually the cash is generating or it's just the numbers and the working capital continues.
You can have profit, but you may not have the cash.
Absolutely. That becomes a litmus test. Then definitely the list, the capex, capital expenditure vis-a-vis in the business you are in. So these things become extremely important.
So you are able to compare things.
Yes. And very important aspect is related party transactions. Most of the things that we have looked into, we have seen companies, we've seen a good big restaurant company paying a large amount of rent to its founders.
Okay.
We have seen an airlines company which was paying as agency fees twice of that of profit of the company to one of the founders, and the company eventually went bust very recently. So these are the aspects you should look at.
Yeah, what comes to my mind is WeWork. The founders themselves are the biggest, landlords.
Right.
So, what not to get impressed, Annual report comes up very nicely dressed up. They are very stylishly designed, produced, printed on glossy paper, nice pictures. They look very tempting.
Right.
They sometimes, some very unimpressive company has very impressive annual reports. Not to say that some great companies also have great annual reports. So what not to get impressed with?
Look, so one is, and I have a background of looking at technology companies a little more. So I've seen that you should clearly avoid jargons. These large, big names that people talk about in technology and other industries. Jargons, that is one. Second is celebrity CEOs with great commentaries and great speeches written on annual report. which is not reflective of the business and the environment. And thirdly, too much focus on the opportunity size in the annual report. If you are reading through the annual report and management discussion, and 90% of that is talking about only opportunity size and does not highlight how do they plan to execute their plan,
things.
then maybe you should be careful.
Okay, so this is key. Looking at pointers to how the business will execute things. Talking big is not a big deal. Anybody can talk big.
Sure.
Focus on execution. So, what kind of forward-looking insight which you get suspicious of, and what do you actually look for that management will be speaking with clarity in terms of what exactly they intend to do, because this is the only formal occasion. Because all other quarterly reports and other things I have seen, the transcripts and other things where management try to abstain from giving you a forward-looking statement. They just try and explain things, clarify things, but they don't say where they are up to, because maybe they are apprehensive, or maybe the compliance standard and other things, norms prohibit them. So what kind of forward-looking things you actually look forward to? Can you cite me an example where you got very excited after reading something in an annual report about a company?
Yes. So one of these better doing cement companies, and if you look through last 4 or 5 annual reports, or maybe last 10 years annual report, you will understand how the business is getting superior and why the profitability became superior of that business, and the return on investment or return on capital employed also got superior. So each and every plan was executed so well, and it was discussed in each of the annual reports.
Okay.
So in terms of the capital expenditure, right, how they ensured that they were one of the lowest in terms of capital expenditure per ton.
Okay.
How they executed that. Secondly, if you look at, and I'm talking about a cement company, in cement, if you add up the inward freight and the outward freight, essentially it is a logistics business where you cut the cost of logistics. Right? Cement business is all about managing the cost of logistics, inwards and outwards. So in the
getting the limestone and crushing it and sending it back. So
yes, it's essentially a logistics business. So if that company highlighted about 10 years ago that we will be building plants only on pet coke and not on coal, right? Because coal is voluminous. Pet coke might be a little more expensive, but it has higher calorific value. This ensures that instead of bringing in 3 trucks, bring in 1 truck of fuel only. Right? That reduces your
energy cost.
That's a very important insight that we got. Secondly, while in terms of output, what they did was they were making clinker near the limestone and transporting it near to the marketplace where they were mixing it. That reduces their logistics cost. Right? So these are the insights when you read continuous annual report, that, and the company's continuous focus on the cost. Okay, now I'll take this, then I'll go on to waste heat recovery.
Cost is the advantage and they focus on that.
Yes. So and this is how they build and maintain their economic moat.
And 5 years looking at it, so you were able to gain their annual report.
Very high comfort level that came in.
You had full confidence in what they are stating.
And they were executing also.
Recently, I was talking to one of my analysts about a company, and I asked him that, can you find about this company, because I was not able to find any of the promoters. He's an old promoter of this company, Hawkins, and I was asking him that, could you figure out what he has to say, what is the future and all that. He said that here is a promoter who says in his annual report, and he's repeating it, after 3 years, that we are not going to do anything new. We are going to do only things better. We will just be doing, so he was so high on not doing anything new. That came as quite a surprise. But here is the old promoter who is running his company his way, and he was very focused on the quality of things and other things. So just doing things better than doing new things.
Yeah.
So that was quite a revelation to me.
Yeah, and one annual report that we read about 4 or 5 years ago, and that gave a revelation that at the first instance you feel that something is wrong with the company, then you meet the company and understand, okay, there was some problem which is about to get solved, and that could be the catalyst for the stock.
Okay.
Right? So for example, there was this specialty chemical company which was doing well, then they did a lot of R&D and set up a capex for a new product. Okay. But for at least for 2 years the numbers did not come. So most of us and the street also thought that there was something wrong with the management.
Bother about the street?
No, essentially, I'm talking about the stock did not move because the earnings did not come. And we were also bothered by why is it happening. But we took an appointment, we met the man. Then we realized that in specialty chemicals, it is one thing to create a product in the lab, and other thing to build it on a scale basis.
Operationalize
it. So in terms of the balance of that plant that has to be created and the right matrix of the product, because it's a specialty chemical, it's very, very difficult to replicate the R&D product into the mainstream.
Manufacturing processes.
Yes.
Okay.
So it takes sometimes. So this time it took 2 years, and we knew that this was happening, and that was the reason numbers were not coming. And once the numbers started to come, the stock just flew. Right? So these are the things that helps.
So I think we have talked in great detail about the annual reports. How much of it is, as the way money compounds, your knowledge compounds. So, after reading annual report for 5 year, 10 year, 15 year of the same set of companies, how does your understanding of annual reports changes when you look at the next incremental annual report of the set of companies that you're interested in?
Look, so it's all about expectations. So we know that first we set expectations on certain managements. We know that certain managements can be over the top. They can be a little more optimistic. Certain managements will be a little more. There are certain managements where so much detailing might not be required. They have a great track record. We've seen it for 10, 15, 20 years. Though you look into a lot of things, but there are certain managements, that there could be some mischief that is happening, and especially in newer companies.
You'll be looking at it with a magnifying glass.
Yes.
Okay.
So all the details, footnotes and everything has to be, and especially the related party transactions and other things becomes very, very important.
Have you noticed anything noticeable in this year's annual report ever since the rules for, or greater accountability for the auditors? The auditors' report are expected to be more explanatory. So have you noticed anything significant?
So this key audit matter that people have started to highlight, and this one of these large media group companies, which is in some sort of trouble because of founders over leveraging themselves. If you look at its annual report this year, it clearly states where the statutory auditor has said clearly its key audit parameters that the internal control of the company is not comforting. And this was a clear line. And that's very, very. It was not a qualified audit report, but still within that category of key audit parameters, they've highlighted that.
Oh, so it's clearly saying that they would like, and now it has become almost a shareholders owned company. So now there is more to worry. But maybe it's just an evolution in the life of a company.
Sure.
Okay, so enough about annual report. Now I'll take your questions. With Sorbh. Arpit is asking how to do value investing while doing a job, as it is hard to prepare valuation models and read bulky annual reports for multiple years. Even if you find one, only stocks which are in news show some movement, whereas others, even having good value and financial health, remain undervalued for multiple years. I think looks like a question for me. Buy a value fund, and that's a shortcut. Of course, if you are, I agree with you that if you have to invest in stocks directly, you better be interested or don't. But what do you say?
I completely agree. There is no shortcut to research and investment. It's an ardent process, and sometimes it can be boring for people who are not used to reading a lot of stuff. So it's a full-time job, and there is no shortcuts of doing this. And the second part of your question that you talk about, that sometimes value can take a little long. It's a patient man's game, and there could be catalysts which take some time to play out. But yes, if you've done your research well, it will play out. So it might not do well in next 3 months, 6 months, but if you have done your research properly, the company will arrive at its intrinsic value, and you will get your returns.
Arpit, I will give you a rider and actually leave you confused with my two answers. One is that the joy of knowing more about company, the curiosity, exploring further, knowing about company in greater detail and keeping track of it, that is a joy in itself. And of course, investing is hard. You need patience, you need temperament and all that. So if you have all that, maybe run a small portfolio of stocks, which will not jeopardize your thing, just in case you don't have time, you end up traveling or you are not able to attend it. But the sheer joy of exploring things, finding answers to your question, being curious, reading annual reports, that could be a great bonus. That I look at as a bonus for many investors, many interested investors, and it will be put to use because the understanding and knowledge also compounds. Now, Paresh is asking, looks like a question for me. in an investment portfolio of mutual fund, what percentage should be allocated to value category? I would say it should be meaningful. I still feel that the charm of growth investing is too high, and but it should be a third of your portfolio if it's a large one, and if you're a conservative investor, it could be little more. It could be half of it. But at the same time, don't negotiate, don't compromise on the basic methods in terms of being a regular investor, not getting sticking to your strategy or in your investing plan, even in the downtime and all that. So carry on. It should be meaningful, and it will not be continually rewarding, and that is the charm of it. When it becomes rewarding, it actually compensates for all the years of underperformance. Abhay is asking question that what is the fundamental reason for most of the mid caps not performing even when index is touching a new high daily?
Look, so the broader market, the mid cap and the small caps are reflecting what is happening in the economy. The main index is not reflecting that fact, driven by few stocks. That's as simple as that. The GDP is at a 10-year low. Ideally, the market should have been much lower levels, at least the benchmark index level. So mid caps and small caps are reflecting the fact that is happening in the economy.
It's very narrow and understandably so.
Yes, and the large caps driven by at least 3 or 4 stocks is not reflecting that fact.
Okay. Nakul Gupta is asking that how can we make out whether the points mentioned in the annual report of a company are true and not just professionally crafted facades?
So there are only 2 things you can find out. One is reading the historical annual reports and looking from that perspective, and thirdly, reading the annual reports of competition. There are 2 ways. Besides meeting the person who's written that, there are only 2 ways of analyzing that. One, you read the historical annual reports as well and see how well they've executed, or they're just facades as you're talking about. Or and also go through the competition about how they are talking about the business environment and other things. So these 2 things will help you get a perspective of things, and you'll be able to analyze good and not so good.
Now here's a very specific question for you. Why Apurva Panchal is asking, why are value funds not performing well for last 3 years? Value stocks are fundamentally so strong, hence it should do well. But we can't see any great return in comparison with large cap funds.
Yeah, so
but nothing prohibits you to be in large cap stocks only.
We are in the large caps, but we are in the large caps which are value and which are
out of favor.
As of now, you're right,
Yes.
they're out of favor. And within large caps, there are few companies where valuations are prohibitive according to us, and so that's the reason we don't own them. And the way the market have structured in last 1.5 years, that there's few names which are quality, if I can call so, at least perceived to be quality, and all the investors are making beeline to invest in them, and they're not taking into fact what valuations it is trading at. So that's the reason that only few stocks are moving and broader stocks are not doing that well, despite being great value and having catalysts in them too. But we have seen these phases. We've seen this happening between 2006 to 2008. We've seen this happening between 2014 to 2015. So there are phases that happens where market does not believe what you believe or you practice, but eventually, But eventually, we have seen that if you have a real strong value process, then things fall in place, and you generally outperform more medium to long term.
Now Raghuveer is asking that how many stocks should we have in our portfolio? Is there any thumb rule?
It's not essentially a thumb rule. Yes, it should be well diversified, but I can tell you what we do. We generally tend to have between 25 to 40 stocks in the portfolio. We'll like to have at least 2% weight in a stock going at cost, and going up to 6% at cost, depending upon the comfort of at cost. Depending upon
at cost, meaning that you buy 100 rupees to be invested. 2 rupee will be invested, that is the minimum investment, right. And that 2 rupee in the overall, if it appreciates and becomes 10 rupee, you'll do nothing about it.
So at 10, we'll do something about it. One, if it breaches the valuation threshold that we have for the company, that is one. And secondly, we'll do if it crosses the 10%.
If it does not breach, then you will...
We'll keep it, the maximum cap is 10%,
of the portfolio.
Yeah.
Okay.
So the weightings are between 2% to 6%, depending on our comfort on the business, the balance sheet and the management. and so our 25 to 40 stock portfolio, little we believe that makes sense, and we have seen historically that's a well diversified, but the tail is not too long so that it does not make a difference. So that's the risk of having a long tail. So don't want to take that.
But there is another saying that, diversification is useful. You should have adequate diversification so some of your theories don't work well. You will not be in great difficulty. But most of the risk actually comes from not knowing what you are investing in. So keep an eye on that. The compromise between diversification and concentration is just a matter of knowing and your own comfort level. But his rules will come in very handy. Now here is a question. Ryan Almeida is asking, historically prices of gold have shown an inverse correlation with equity markets. Is it right time to invest in gold funds considering that they have done well over the last 1 year and equity markets are also abnormally high without any fundamental basis?
Look, it's more of an asset allocation question, but what we generally recommend, and when we talk to investors, that some portion of your money should be in gold, maybe 5%, 10% depending upon your comfort, because gold does well when the world is not doing that well. So for example, 2008, when there was a risk on US dollar, gold was up and the index, the equities were down by 50%. Similarly, in 2011, when there was a euro risk that was playing out, the indexes equity was down and the gold was up. And last 1 year, when we have a lot of news on things like trade wars and other things, then again gold has started to do well. So yes, a small allocation on gold is essentially a good balance in terms of asset allocation.
Yeah, so I have a contra view to this, which is the whole thinking behind equity investing is that world will be a better place in times to come. So when gold does very well when the whole world looks shaky, and generally the world does well over a medium term, longer term period. Whenever I look at any 5-year period, 10-year period, we look to be better. We seem to be better in relation to where we stood. So in that sense, a long-term bet should be equity, and fixed income should be your stability providing. It should be the shock absorber, and gold you take a bet. So thank you very much, Sorbh, for sharing your insights on how to read annual report, making sense of annual report, and answering our visitors' questions. Thank you. Thank you very much for coming over. Watch us again next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.